Hi, so today in part 2 of my insurance series, I'm going to go through some of the most recognizable international brands in the insurance world. And if you haven't watched part 1, well, I highly recommend going back and watching that to give you a bit more of an understanding of why insurance isn't so boring. So today I'm going to look at the major international players in insurance, and then in the next video I'm going to look at the major American players. And I'll tell you now that there are two very undervalued insurance companies in today's video, so make sure you stay to the end. So my channel is supposed to be about investments that anyone in the world can make. And I think as an investor, I really shouldn't focus on one particular marketplace like America. I really should be looking globally, because at the end of the day, all I'm really looking for is a good investment. So I don't really care where that is. If that's in Italy, great. If it's in America, great. Now the companies I'm going to take a look at today are AXA of France, Allianz of Germany, Assicurazioni Generali of Italy, sorry about the pronunciation, Ping An of China, China Life also of China. Now I chose these companies today because these are actually some of the biggest insurance companies in the world. Now I do like a bargain, and there are literally hundreds of different insurance companies all throughout the world. So if we can understand these big ones, well, maybe that will help us understand some of the smaller ones in maybe your own country. So AXA or AXA is a Paris-based insurance company that is the second largest insurance company in the world based on net premiums. Now they're not just for the French market, they've actually got subsidiaries all throughout the world, and they're really a global conglomerate. And AXA, well, this company is not a fast grower. It has definitely matured. So because of this, we'll be looking to invest because of its value rather than its growth potential. Now, I'm going to go through the key metrics for when we're analyzing an insurance company, and they are slightly different to when we analyze, say, another company from a different industry. So I'll look at the debt to equity ratio, the earnings growth, return on equity, a combined ratio, and the price to tangible book value. So I'm going to explain each one of these in detail for AXA or AXA of France, but I'm not going to go through it for every company because we can just use the same principles and apply it to the others. So first we'll look at the debt to equity, and it's extremely unlikely that any of these companies will go bankrupt. But with high debt, it means profit will be squeezed because of the larger repayments. So we definitely prefer lower debt in every company, regardless of its size and stability. And AXA's debt to equity is 0.6, and normally I want to see this below 0.7, so it's at an acceptable level. Now for growth. Now we're looking here at the earnings per share, and AXA has been volatile of late, but it is expected to perform well over the next few years. Now this is AXA's free cash flow. Historically, it has been declining over the past decade, so we need to factor that into our calculations. A little bit later, when I'm going through my intrinsic value calculator, well, I'll show you exactly how to factor this declining free cash flow into our calculations. Now for return on equity. And for AXA, well, it's low at about 5%. Now I want to see this over 10%, 15% would be far better. Return on equity, well, it's simply just how well the management team are using the money that they have to grow the company. So now we're going to look at the combined ratio, and it's really an insurance ratio that tells us if the money generated from all the insurance premiums are going to cover all the payouts. So what we want to see is it under 100%. If it's over 100%, well, that's bad. So AXA reports their combined ratio for each segment and each region. And what I want to see is it under 100%, and most years to be under 100%. See, an occasional over 100% number isn't a really big problem. It's just generally we want to see it under 100%, and that's what we're seeing for 2020 so far. Now, if we compared what we just saw with 2020, well, it's worse than 2019, but claims have risen because of like the lockdown situation, so I think it isn't out of control at all. So now we move to price to tangible book value, and this is a very important valuation metric for mature companies. This is the number that will tell us if this is a good deal or not. So what this really means is we're looking at the current share price and we're comparing that to the current real assets of the business. And when I say tangible book value, well, what we're doing here is we're taking out things like goodwill and other intangible assets. Intangibles are really things that are just not physical for the business and that are still worth something. So for example, a brand. And we take this out because some brand names are worth something and some brand names maybe not worth anything. And generally putting a value on a brand is next to impossible. And what we don't want to get caught doing is when we look at a company and they value their brand really high, but that's not really what it's worth. So they could make the business look far more valuable than it actually is. So simply enough, we just take this number out, so it just makes everything so much easier to value. And when we're looking at the price to tangible book value, well, we want to see this number under 1. Because if it's under 1, well, this means that we're buying this business at less value than it's actually worth. Now, sometimes we might even see a price to tangible book value at, say, 0.5. Now, that seems amazing at first, but we have to still look a little bit deeper just in case there's something very problematic happening to that company. So we actually have to be really careful when we're using this number because we don't want to invest because of it. We just want to use it as an indication to research further. So AXA's price to tangible book value currently is 1.48. So it's on the high side in my opinion. So using my intrinsic value calculator, which by the way is free in the description below if you want it for yourself, I got a fair value of 19.85 euro a share. So halve that and we get my buy price at about 10 euros per share. Now the reason I halved it is because I want to get a good margin of safety, and I do this with nearly every investment. And just for reference, here on the screen are all the inputs that I use for the intrinsic value calculation to reach my fair value. Okay, so now I think you understand the process that I'm taking to analyze an insurance company. And instead of going through each one of these one by one, well, I've just collated all of this information that I just did for AXA and I've just put it here in this table for the other companies. So let's take a look at what we have. So the next company we're going to look at is Allianz, which is a Munich, Germany-based insurance company, but similar to AXA, they are truly global. They pretty much handle all the different types of insurance you can think of. So definitely another mature global conglomerate. Now, I think they're a solid company with better fundamentals than AXA, but the price has a long way to fall before I'm interested. Okay, now we'll do Assicurazioni Generali. Oh, I think I got that one right. So it is a big Italian-based insurance company, mostly serving the European countries. And it's actually still one of the bigger insurance companies in the world, even though it doesn't have the global reach of AXA or Allianz. Now, the return on equity here is a little low, and it isn't a bargain either, but the combined ratio is under 90%. So it's really strong and safe. If the price was to fall to the buy range, well, it wouldn't be a bad investment at all. Now let's move on to the Chinese companies, and we'll start with Ping An. Now this is a very interesting company. They are a high growth insurance company that's also in tech. So it's a bit of a strange mixture. I think they kind of want to be a little bit like Alibaba. But regarding their core business, well, they are truly an insurance company that has been gaining market share in China. They have lots of very reputable backers as well, from Morgan Stanley, Goldman Sachs to the Shenzhen government. And regarding growth, well, they've been growing fast like a tech company, and I think they're undervalued because of this. But unfortunately, their debt to equity is high as they attempt to grow big. So they do hold more substantial risk. Now, I try to factor that into my calculations for a buy price, and I still think it is a really good price right now. The problem is, it's actually just really hard to calculate the fair value of a high growth company, especially a Chinese growth company. So maybe the safer play is to look at China Life Insurance, which we're about to do next. But I'll actually be digging a little bit deeper into Ping An because I think there could be a bargain. So last up today, we're going to look at China Life Insurance. Now, this is 70% government owned, which makes things difficult to read. The fundamentals really do look good though. Very low debt, reasonable price to tangible book value, and the intrinsic value is also really good. It appears to be a great investment, but the 70% government owned thing, well, that's a bit tough to trust. So again, there is some risk here, and I think it will require a lot more digging. Now, regarding the digging, one of the rating agencies called Fitch have actually done a lot of the digging for me. These rating agencies put a lot of manpower into analyzing these companies to see how safe they are for investors. And they've given China Life Insurance a strong A+ rating. Look, this does mean something, I guess, but it's not really a reason to invest either. And another problem I had was I spent hours and hours and I looked everywhere for the combined ratio and I just couldn't find it anywhere. So I would want to know this before I started investing in China Life. So I think Ping An and China Life Insurance, well, they definitely warrant some further research. These could be great bargains with big upside, and I think it's also a pretty interesting play on the Chinese economy as a whole. And regarding the 3 European-based insurance companies, well, I think they're all a bit overvalued based on their growth rates. And competition, well, it's fierce in their space because, like I said before, there are hundreds of insurance companies all over the world that would probably want to expand into Europe at some point. So I think the 3 European insurance companies that we looked at today, well, they don't really have large barriers to entry into their marketplace. Okay, now after doing all of this, I'm very interested to go and do some research into the American insurance market to see if we can find something special. And I'm now feeling very confident that I know what to look for when we're analyzing an insurance company. I hope you got something out of this video and gained some more insight into international insurance companies. Make sure you subscribe so you know when I drop the video about the American insurance companies, and I will see you in the next video.